Chicago. I notice that you don't like to interrupt my whistling. I think you find it. I think
no,
you
I
find
have
it.
enough.
I think you find it soothing.
No, I don't. Yeah, I'm going to fall asleep. See, um,
Look, every year is complicated. Last year was complicated for whatever reason, and this year will be equally as complicated for some other reason that I have not even thought about yet. But the idea is to stick to your principles and buy and hold those things that are out of favor and cheap, and wait for the crowd to rush back and favor them. So last year, after about 2 months into the investing year, people decided that the defensive things that they had been holding and pushing up in price, maybe that wasn't the place to be after it having been the place to be post-financial crisis. And they decided that they should instead move into those things that would do well with the world that's growing a little bit. And there was a massive, or the beginnings, I should say, the beginnings of a movement of capital from those defensive sectors into things that are more, that do well in a recovering economy. And we were already positioned in those things, and so we've enjoyed some incremental increase in value, and our portfolios were up 40, 30, 20% depending upon the mandate. And there's more to come. When we measure our portfolios in aggregate, the value of the individual securities put together, we still see a gap between what they're trading for and what we think they're worth, of something in the order of 3.5 to 6.5 times. And you asked me when I'll be happy. I'll be happy when I see them trading for approximately that valuation, because then it'll be time to move on to the next thing. And I'll take a week off, go to the Barbados, go swimming.